If you're anywhere near the world of investing or, even just thinking about it, you know the feeling.
Oh, for
We're
sure.
watching the charts, you're glued to the news, and there's just one question that's screaming in your head. When?
When is the perfect moment?
Exactly. When's the perfect day? The perfect price to get in? There's this deep-seated idea that you have to be some kind of genius market timer to succeed.
It's this constant chase for the perfect moment, that if you don't catch the next big move, you've missed your chance. And that pressure, it just leads to agitation.
Absolutely. But today, we're going to dive deep into some sources that really systematically challenge that whole stressful idea.
Yeah, we are.
Our mission is to unpack a principle that's often overlooked, not because it's complex, but because it's almost shockingly simple. We're talking about time in the market.
And we can probably just anchor the whole deep dive right here.
Mm.
Morgan Housel puts it perfectly. He says, the market rewards patience, not agitation.
I love that.
It's not just a nice quote. It's a reflection of the actual mechanics of how wealth is built over time.
That difference, patience versus agitation, that's everything, isn't it? Agitation is that constant impulsive trading, trying to react to the daily noise.
Whereas patience is just riding out the waves.
And we're going to show exactly why duration, not some tactical genius, is the real key to capital growth, according to the research.
And just before we jump into the hard data, it's probably a good idea to set the context really quick.
Good call.
What we're sharing here are powerful principles, ideas synthesized from decades of market history. But this is for your information, for inspiration. It's not personalized financial advice.
Right. Always do your own homework.
Investment always has risk. So, okay, let's get into it.
Let's start with the absolute foundation, the real nature of the stock market. What do the sources tell us about how it actually behaves?
What's so fascinating is that the market really has this dual personality. In the short term, day to day, it is genuinely erratic.
It's pure chaos.
It is. It's governed by breaking news, by quarterly earnings, by, frankly, raw human emotion. It's a messy system.
You could almost describe it as like a highly reactive, short-fused entity.
That's a great way to put it. But, and this is the important part, the research shows that when you zoom out, when you look at it over decades, all that noise starts to fade away.
And a clear signal emerges.
A very clear signal. The general trend over the long haul is consistently bullish. It goes up.
Okay, this is the critical point. We need to explore why. Why does that long-term trend stay positive? The market's been through wars, pandemics, crashes.
Yeah.
What's the engine that keeps pushing it all upwards?
It really comes down to the fundamental forces that drive us forward as a civilization.
So not politics or economic policy.
Not primarily, no. It's fueled by something more basic. The relentless human drive for progress, for innovation, for creating value where there was none before.
Can you give us a quick example of what that engine looks like on the ground?
Sure. Think about it. Companies exist to create more value this year than they did last year. That's their job.
Right.
So whether it's developing a faster microchip or figuring out a more efficient way to deliver goods or finding a cure for a disease, that all drives profitability. And then you add in things like population growth, a little bit of inflation. The total value of everything just keeps expanding.
So that long bullish trend is just capturing the rewards of that global project of human progress.
That's it. You're riding the wave of human ingenuity.
So if we accept that there's this inherent positive bias over the long run, the conclusion kind of writes itself, doesn't it?
It does.
The sophistication you think you need to anticipate the next dip becomes way less important than the simple amount of time your money stays in the game to capture that big upward trend.
Time basically replaces tactical genius as your most powerful tool. It's just about being present for the journey.
Okay, this is where we have to shift from the philosophy to the hard mechanics.
Yes.
Because this is where so many investors get tripped up.
It is.
It feels so intuitive, almost responsible, to run for cover when things get turbulent. Sell your stocks, de-risk. But what's the real danger in doing that?
That intuition is a very, very high-cost mistake. The sources are crystal clear on this. When you exit, even for a little while, you risk missing the market's rebound.
And these rebounds aren't slow and steady.
Not at all. They are violent, concentrated bursts of performance. They happen fast.
This is where we need to bring in that really surprising fact from the research. We're not talking about missing out on general growth. We're talking about missing hyper-concentrated performance on just a handful of days.
Exactly. There are studies showing that a huge chunk of an entire decade's market return can be packed into just the top 10 or 20 trading days.
That's wild. Just 10 days.
If you're invested for that whole decade, you catch all of it. But if you try to dodge the downturns and you miss those few key days, your overall return can be just crippled.
And what's so counterintuitive is that these best days, they don't happen when the headlines are all sunny and positive, do they?
Never. They almost always happen right after the absolute worst periods, when fear and panic are at a fever pitch.
That is the behavior trap.
It's the ultimate trap. People sell out of fear right before the slingshot recovery. And when the market does snap back, it's not because everyone suddenly feels optimistic again.
No, it's the big money. Right?
It's institutional capital moving back in. If you're waiting on the sidelines for things to feel safe again, you've already missed the most important part of the recovery.
Wow. So by trying to avoid the turbulence, you basically guarantee you miss the moment that erases all the turbulence.
You've said it perfectly.
Okay, so that's the first mechanical benefit of staying invested.
Yeah.
Capturing those crazy, unpredictable rebounds. What's the second big one?
The second one is the one people have heard of but maybe don't fully appreciate. It's the snowball effect.
Compound interest.
Compound interest. The process where your gains are reinvested to produce even more gains. But the key thing to understand is that compounding is not linear. It's exponential. It needs time, a lot of time, to really work its magic.
I think people get the concept, but they don't grasp the sheer scale of the difference between, say, 5 years of compounding and 25 years.
The difference is staggering. I mean, in the first few years, most of your growth comes from the money you put in. But once you get out to year 15, year 20, the growth is overwhelmingly coming from the returns on your past returns.
The snowball is finally rolling on its own.
And time is the exponent that makes it grow faster and faster. If you interrupt that cycle by pulling your money out during a dip, you don't just pause the growth, you shrink the snowball right when it was about to get really big.
So we've covered the financial mechanics.
Mm-hmm.
But the sources also make a strong case for the psychological side of this, don't they?
They do. And this moves us into behavioral finance.
Time as an emotional stabilizer.
Right. If we go back to that patience versus agitation idea, committing to a long time horizon is the antidote to the emotional turmoil that sinks most investors.
Yeah.
Well, it immediately neutralizes things like loss aversion, that psychological quirk where the pain of a loss feels twice as bad as the pleasure of an equal gain.
Because if I know I'm not selling this for 15 years, a 20% drop this year stops being a catastrophe.
It just becomes a expected, maybe even boring part of the process. A long horizon forces you to see volatility for what it is.
That's noise?
Just noise, not a signal to act. You stop reacting impulsively, hotly, to the turbulence, which is when people make their worst decisions. Your timeline is long enough that you can just breathe.
It totally transforms your mindset. You stop acting like a panicked gambler staring at the ticker, and you start acting more like a patient part owner of great companies.
Yes. You're trusting that the underlying value creation will continue, which, as we discussed, it historically does. It's a much more serene relationship with your investments.
And that serenity is what allows you to stay in the game long enough to actually get the benefits of compounding and the market rebounds we were just talking about.
It all connects. Patience is your best ally. The dips become less scary and more like routine steps on a very long journey upward.
But this powerful idea of patience and duration, it's not a magic bullet, is it? We have to go into some critical thinking here. You can't just blindly stay invested in anything forever.
This is such a crucial pivot. The sources remind us that we have to integrate this principle without it becoming a dogma.
There's that great quote from Charlie Munger.
Take ideas where they are, but use your own brain to assemble them.
The Munger mandate. It's about conscious application, not blind faith. So if patience is the strategy, how does an individual listener use their own brain to assemble their plan?
It means everyone has to do their own research and make decisions based on their own unique personal context. The sources are clear. Past market performance is not a guarantee of future results.
Right.
Your investment journey is really going to be defined by 3 highly personal factors.
Okay, what are those 3?
First, your personal objectives. What are you even saving for? Retirement in 30 years is a totally different game than a down payment in 3 years.
Of course.
Second, your time horizon. This defines what long-term even means for you. If you need the cash soon, the market's long-term bias is kind of irrelevant.
And the third?
And third, your own risk management framework. What level of volatility can you actually stomach, emotionally and financially, without hitting the panic button? These are different for every single person.
It really underlines that investing isn't some off-the-shelf product. It's a personalized journey, even if the guiding principle is a passive one like duration.
And this brings us right back to the formal clarification. This whole deep dive is designed to be educational, to give you the framework for understanding these principles.
But it's not advice.
It is not and should never be taken as personalized advice to buy or sell anything specific.
We're giving you the map, not telling you which road to take.
Absolutely. The sources remind us, again, past performance doesn't guarantee future results, and all investing carries a risk of loss. The smart approach is to keep learning, keep strengthening your understanding, and if you are in any doubt at all, talk to a certified professional before you make a decision.
That feels like the balanced approach. And it brings us back to where we started, but now we're armed with the why. The market rewards patience, not agitation, because time is that quiet ally that lets compounding and innovation do their work.
Summing it up, your most powerful strategy is just constancy, using that duration to smooth out the noise and capture the long, upward trend of human progress.
So what does this all mean for you, the learner? Here's the provocative thought to take with you. If time is the greatest multiplier of capital, what kind of time, what kind of future independence are you actively trying to buy for yourself with the money you're investing today?
That's a powerful question.
Think about that horizon and what true financial patience really allows you to build. If this deep dive has inspired you to move toward that goal, toward buying back your financial freedom, well, we want to hear about it.
We do.
Please take a second right now to add a like to this deep dive and subscribe to the channel for more. And if that idea of financial patience really hit home for you, let us know in the comments below by just typing the word freedom.
We really appreciate you joining us for this crucial conversation.
Until next time, stay curious and stay patient. Farewell.